What's up, everyone? It's Karthik with MoneyVest. So the Fed is set to cut interest rates by 50 basis points tomorrow, so Wednesday, September 18th. However, there is still a lot of indecision or uncertainty around how much the Federal Reserve is going to cut interest rates by. JP Morgan's predicting a 50 basis point rate cut. Citigroup, 25 basis. Bank of America, 25 basis points. Goldman Sachs, 25 basis points. BlackRock also mentioning that the Fed won't cut interest rates as deep as the market expects. So there's really never been so much uncertainty and indecision around how much the Federal Reserve is going to cut interest rates with less than 1 day left for the meeting. I mean, the Fed meeting is literally tomorrow. It starts today. The FOMC meeting starts today, but we've got the press conference and, of course, the summary of economic projections and the interest rate decision from the Federal Reserve tomorrow, Wednesday, September 18th at 2 p.m. Eastern. I will be live to cover that, but the markets right now are fully priced in for a 69% probability that the Federal Reserve is going to do a 50 basis point cut. Now, this would be considered as a fast cutting cycle. If the Federal Reserve indeed embarks on a bigger cut of 50 basis points, it's going to be a faster cutting cycle. And that's exactly what I want to discuss in this video. All I'm asking in return is that you drop a like, subscribe, and share this video with your friends and family, other traders, investors that can benefit from this information, because I've taken a lot of time to put together a lot of these numbers on this spreadsheet to bring you the best data possible. And we're also going to be going over this particular spreadsheet as well. So again, hope you all enjoy it. Find it helpful. Make sure that you drop a like and subscribe to the channel. So first things first, let's come over to the seasonality effect, because September, as we already know, is one of the worst months for the market, and we are now entering, right? So we are pretty much in the back half of September. It's usually, not always, but usually one of the worst times for the market. Not just the month itself, but also the timing of this month, which is the back half of September and the worst 2 weeks of the year for stocks. You can see that starting September 17th, basically, which is going to be today, all the way to the 31st, or 30th, I should say, we have seen significant red along, pretty much across the board, as the last 2 weeks tend to be very, very brutal. And this right here, the second half of September being the worst, comparable to the second half of June, and the first half of July being the best 2-week returns for the S&P 500 since 1950s. So again, this is some incredible seasonality to take into account, as we are pretty much over here right now, more specifically right about there, as the second half of September tends to be, again, very bad. And this right here is how September progresses as time goes on. And also, Tom Lee mentioned in his update on CNBC that, once we get a really brutal start to the month of September, once we start to see over a 2% down week the first week of September, 100% of the times, right? 20 out of 20 times, we've seen September to close down, right? So it's been a red month overall. Even if we claw back some of those gains in the rest of September, it's been a red month overall. And we've never really been able to close green. And so maybe this time is going to be different. I doubt it, but we're going to find out over the next couple of weeks here. But this is really how the progression happens towards the back half of September, starting September 19th, and the markets absolutely just, get crushed towards the last 2 weeks. And not to mention, we've also got now the Federal Reserve meeting tomorrow as well. So now moving over to the fast versus slow cutting cycle, I took the liberty to go over to some of the data points, and when the Federal Reserve has cut interest rates by 50 basis points or more to start the cutting cycle versus when they have opted for a slow and steady process of 25 basis points. And you'll notice that the markets tend to see the 50 basis points as a little bit more alarming than anything else. And look, the cut itself doesn't have a lot to do with the market's response. It's really what that represents. Okay, so I want to be very clear that just because the Federal Reserve may be cutting 50 basis points doesn't mean that that in itself is a signal for the markets to sell off. It is really, what does that cut represent? Does that represent panic? Does that represent recession? Does that represent some economic weakness? Or does that represent nothing? Right? So if that represents nothing, it's just 50 basis points because they feel like the policy right now is too restrictive and they want to come down to a more normal policy, then the markets can really just ignore or shrug off some of these fears around a potential recession and continue to move alongside, potentially new all-time highs, right? So as we've been trading pretty much back and forth, it would not mean much. But if the tone, if there's any signs of economic weakness and why they're cutting 50 basis points has a representation of a potential recession, then that, of course, will not be well received by the market. So it really just comes down to what that cut represents. It's not so much a 25 or 50 or 75. It really, what is the Federal Reserve trying to convey to the market? And I think a lot of that is going to be learned from Jerome Powell's speech, as well as the summary of economic projections, because the SEP is going to also help us understand the economic growth that the Federal Reserve is forecasting. If there's any revisions to the downside for economic growth, I think that can send the wrong message to the market that, okay, they're raising 50 because they're expecting the economic weakness to continue, and they're expecting the economy to grow at a slower rate than what they originally thought. So I think that's really what's important to keep in mind. And if you come over to the fast cutting cycles, the average and the median gain for the market is a lot less 1 year later than it is in a slow cutting cycle. So what I mean by that is, if you come over to 1970s, 1974, 81, 89, 2001, 2007, 2019, these have all been fast cutting cycles. And I've mentioned before that 2001 and 2007, that's literally the last time we saw 50 basis point cuts from the Federal Reserve, which resulted, of course, in the markets essentially crashing over 45 to 50% on the back of huge recessions. Although I don't think and believe that we're in a very similar situation. We're not there yet, but I think it's really important to note how the markets react to those fast cutting cycles. So average gain of 5.7% and a median gain of just over 9% 1 year later, when the Federal Reserve has embarked on these fast cutting cycles. When they've opted for a more slow and steady and calm approach, the gains are significantly higher, meaning every single time we're at least over 20% higher 1 year later. If you take a look at the average and the median gain, and this is 1971, 1980, 1984, 1995, and 1998. So 252 trading days later, we are 20 to 21%, 21% in most cases on an average and median basis, higher after a slow cutting cycle. And even 6 months later, we are higher 18 to 19% of the times. That's the gain for the market versus a fast cutting cycle. We're only up, anywhere from 6 to 8%. And the probability for us to be down is also a little bit more than, of course, when we are in a slow cutting cycle. It's pretty much 100% of the time. So you can see 3 months, 6 months, and 1 year later, the markets are higher 100% of the times in a slow cutting cycle. Versus if you take a look at the fast cutting cycle, over here, we are down 3 out of the 7 times. So that probability really just comes down to, so if I were to do some calculations here, 3 divided by 7, 42% of the times we're actually lower. And then if you take a look at this is also going to be 3 divided by 7. And this right here is going to be 2 divided by 7. So that's about 28.5%. So these are the probabilities. The markets are down or red, after a fast cutting cycle, because 3 out of those 7 times we have been lower. 1981, 2001, and 2007. Then again, 1981, 2001, 2007, 6 months later, and really 1 year later, it's only 2001 and 2007. So it's really just those two instances where the markets were significantly down even 1 year later after a fast cutting cycle. Now, this right here is also our master spreadsheet, which we have created to better track the cutting cycle, S&P 500 gains or losses or returns essentially, and the recession cycle as well. And one of the observations that we have made in our previous updates and videos is that every time the market, of course, goes through a recessionary cycle where there is a recession, the market drawdowns are more severe and more longer lasting. So this is been another spreadsheet that we've talked about where with a recession, the markets tend to be in a bear market, in other words, down over 20%. For far longer, we're talking 16 to 17 months, it can actually be down, in a bear market with an average and median loss of over 36%, versus when we are not in a recession, we're only really in a bear market 6 to 7 months, and that's only in 20 to 23% drawdown from its all-time highs. So recession is what holds the key to everything right now. And the Federal Reserve, while this is an important meeting, this is probably going to be the most important meeting of 2024, perhaps even the last year, because it's a big policy pivot. Recession is what holds the key to the entire market. If there is weakness, economic contraction, if the consumers are struggling, if they're not spending as much, and I would even argue that Apple kind of gave us a little bit of a warning. Not really Apple, but some of the analysts here that are tracking Apple's pre-orders over the weekend that, look, 12%, 13% down in pre-orders year over year is a pretty significant number. I mean, that in itself tells us a lot about where the consumer is, how the consumer is doing. And if they're actually weak, if they're struggling, they're not able to spend discretionary on discretionary items, because look, at the end of the day, everybody wants the best technology. And if they're not spending on the new Apple iPhone, that definitely goes to show that discretionary spending is coming down. And that's usually one of the first signs of how the consumer is struggling in this high inflationary environment. And if that continues, if that weakness were to persist, then, well, guess what? Recession could be right around the corner. And as I mentioned before, I think mild recession is a possibility. I think 3 to 6 months is a fair timeline for us to assume that a recession may take place. And these are some of the other indicators that we've been keeping track of, which is, does the market top prior to a recession starting? And if that number is negative, recession started before the market tops. And if the number is positive, the market topped before the recession started. And this number has been positive since we've been tracking it by well over 5 months. 5 months, and that puts us, market top was back in July. So July is where the market top was, pretty much the all-time high of 56.69. So if the markets do not make a new all-time high anytime soon here, and that July number essentially remains the market top, then based on historical data, we can sort of conclude that, okay, 5 months from July comes out to at the end of this year, early next year is where the markets could be, or economy could be in a potential recession. And once again, we've talked about this. Does the market bottom prior to a recession ending? And if this number is positive, the market bottoms before recession ends. If this number is negative, recession ends before the market bottoms. And this number was also positive by 2 months, meaning the market bottoms 2 months before a recession ends, but we haven't even started yet, so this is not going to be super relevant. And then this right here is a cut to recession lead time, which we've also talked about, where the Federal Reserve, when they start cutting interest rates, right, does a recession follow or not? So if you come over to the rate hiking cycle here, we've kept track of every time the Federal Reserve has cut interest rates and then a recession has followed or not. And you'll notice the last 4 times the Federal Reserve has cut first and a recession has followed later. In previous scenarios, especially when you go back to, like, let's say the 1950s and 60s, recession happened first, and then the Federal Reserve reacted to that recession and they started cutting interest rates. But more recently, they've been a little bit more proactive in going over those recessionary signals, and they've done a good job in kind of cutting interest rates first, but eventually the recession has followed. So you can also make a case that they've been behind the curve, where recession was already coming and they decided to cut first and then a recession followed. But you can also make a case that, okay, they were a little bit more proactive in cutting first and then a recession was eventually going to be that outcome for the economy anyway. But the last 4 times, I really want to address here that every time they've cut interest rates, a recession has followed. So that's where we are with the market. So recession, like I said, is where the key is for the market and, of course, for the economy. And volatility tends to peak during election years in the month of October. We've already looked at the VIX Central, which shows us the forward next few months of volatility futures, suggesting for a potential spike in volatility again. 63% of the times we've seen October be the peak for volatility. Makes a lot of sense because November usually is when the elections are, and that creates a lot of uncertainty, a lot of volatility back in the markets as well. So this right here is the performance for the market, as we've already discussed. In a non-recessionary environment, if it's a growth scare, markets tend to perform a lot better, versus if we are in a bit of a recession as well, then the markets, of course, are not going to be very, very strong. And this right here is something that I've also discussed in my previous update, where the Treasury market is front-running the Federal Reserve right now. So as interest rates continue to be where they are at 5.33%, of course, they're going to be lowered tomorrow. But the Treasury market has been doing a lot of the work for the Federal Reserve because they've been front-running the Fed by coming down already from a peak of 5.5%, now down to under 4%. So that's already a big reduction in interest rates, and it's already been priced into the economy, where interest rates on auto loans and mortgages and everything's been rolling over. So that's already a huge signal that the bond market is already expecting for inflation to come down, for the Federal Reserve to start cutting interest rates, and it's already been baked into the market, in my opinion. So a lot of people asking, whether that's going to benefit TLT or TMF. I feel like not so much, because it's already priced in at the moment, as the Treasury market is already, in my opinion, front running the Federal Reserve at the moment. So that's where we are. Going into tomorrow, 25 or 50 is, yes, it's a very important decision to get us started on the cutting cycle. But as addressed here, A fast cutting cycle most certainly is lower gains for the market over a 1 year, 6 month, 3 month period versus a slow cutting cycle, which instills a little bit more confidence, more stability in the market. But really the key there is going to be recession or not, because that is how earnings get affected, and that's earnings getting affected is what's going to drive market multiples and markets overall. So I hope you all enjoyed this video and a complete update on this sort of recessionary environment potentially, and of course the rate cutting cycle as well. Make sure you drop a like and subscribe to the channel. I've already shared this entire spreadsheet in our Discord, so you can pretty much draw your own conclusions and take a look at your own sort of analysis here. We've got the rate cycle, we've got the S&P 500's performance, the recession cycle, as well as the market cycle over here as well. So we're just less than 1% away from all-time highs, 119% gain for the markets, 62% gain from 2022 lows. So that again has been a very, very good return for the markets overall. So hope you all enjoyed this video, found it helpful. Make sure you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below. Happy investing. I'll see you all in the next video.